Hi, I'm Sue Miller with the Wisconsin Automobile and Truck Dealers Association. This video is intended primarily for dealerships, but may also be helpful for consumers. The key question is, why do customers have to pay sales tax on manufacturer reimbursements or rebates? Wisconsin sales tax is determined by how the law defines gross receipts. It helps to consider three related but distinct concepts. First, manufacturers set pricing programs like employee discounts or friends and family. Second, dealer controlled incentives, sometimes called dealer cash. And third, manufacturer rebates. Under Wisconsin law, sales tax is imposed on a dealer's gross receipts, meaning the total amount received for the sale, whether paid by the customer or by another party. Gross receipts are based on the value of the sale, not on when or from whom the payment is received. In manufacturer employee, friends and family, and similar programs, the manufacturer sets the selling price the dealer must use. The dealer does not negotiate that price and is required to sell the vehicle at the discounted price to approved customers. The manufacturer later compensates the dealer for the reduced selling price, replacing sales proceeds. This is typically noted as the manufacturer reimbursement portion of employee discount on the purchase contract. The manufacturer reimbursement is included in the dealer's gross receipts. Because the manufacturer controls the price, the compensation is subject to sales tax. Tax treatment is different when the dealer can negotiate the selling price. Dealers sometimes receive incentives or dealer cash that they can apply at their discretion. Because the manufacturer does not set the customer's price and the payment is not tied to a required discount on a specific sale, these incentives are not treated as part of the taxable selling price. Manufacturer rebates operate differently from both pricing programs and dealer incentives. A manufacturer rebate is applied after the dealer and customer have negotiated the selling price. The rebate is paid by the manufacturer under terms the manufacturer sets, and the dealer passes the rebate on to the customer. Manufacturer rebates do not reduce gross receipts, even though the customer receives the benefit of the rebate. As a result, the manufacturer rebate is included in the taxable amount of the sale. Dealers are required to report and remit sales tax on gross receipts. Therefore, dealers are expected to collect sales tax on those amounts at the time of sale. This does not represent additional profit for the dealer. Rather, it reflects tax the dealer is legally obligated to pay. This explains why sales tax may be calculated on an amount higher than the customer's final out-of-pocket cost. Sales tax is based on the total value of the sale as defined by law, not on the net amount paid after rebates or manufacturer payments. The guiding principle is consistent. When the manufacturer controls the price or requires a rebate, those amounts are included in gross receipts. When the dealer controls the price, incentives may be treated differently. Understanding these distinctions helps dealers remain compliant and helps consumers understand how sales tax is calculated. Thank you for watching. If you have questions or ideas for a future short video topic, please feel free to contact me at 608-251-8024 or by email at smiller@watda.org.